Earnings are expected to be strong this quarter. Let's find out more from Peter Andersen. He is portfolio manager at Congress Asset Management. He says pick stocks on how the company's bonds are performing. Take a look at the debt. Peter manages equity portfolios for institutional and private clients. He's the former head of high-yield investing at Dreamin Value and Management. Peter, good to have you with us on Bloomberg. Explain a little bit about this idea that you look for the performance of the debt of a company, and that tells you whether you should be buying the stock.
Well, Pimm, you know, ever since the dawn of mankind, bonds and stocks have their own separate worlds, and it pays to start looking at a company in a holistic way. Look at the bonds, look at the way they move. They might give you an indication as to how the stock will move further down the line. Bondholders look at cash flows much more discreetly in a determined fashion than an equity holder. Equity holders look at earnings, momentum, other pie-in-the-sky things, sometimes people would say, whereas a bondholder has to get paid that coupon. If you don't get paid the coupon, you're in trouble. So that focuses them tremendously on the here and now, not the future.
Do you ever get the impression that equity investors recognize that they are on the other side of the fence from debt holders? Because if you're an owner of a company or a shareholder, you're in effect owning a company that's paying the debt holder. I mean, that's where the flow has to go, from the shareholders to the debt holders.
Absolutely. And when you think of it, at the end of all this analysis, we're all looking at the same thing, cash flows. So if we're looking at the same thing, cash flows, why aren't we also valuing the company the same way? And I'll tell you, there is great value in merging those two viewpoints together and having a bond analyst, for instance, and an equity analyst duke it out. If they have a difference of opinion, that's when I get interested, because that means there's no consensus. And when there's no consensus, there's some value to be uncovered.
All right, let's talk about some of the stocks, maybe give them as illustrations. I know that you've been looking at Motorola, for example. They're planning the spin-off of the handset business. What do you think is going to happen there?
Well, first off, let me tell you why I'm looking at Motorola. It came up on this strategy that I was just describing to you. I was looking at the bonds, and the bonds were really outperforming relative to the rest of the corporate bond world. And then when you looked at the Motorola equity, that was underperforming relative to the equity world. So there is an example of a difference of opinion that I mentioned earlier, where the two have to duke it out, the equity analyst and the bond analyst. So when you look at those two, you say to yourself, who is right? You do some fundamental work and say, you know what, I think the bond analysts have this one. I think they've won this match because they've looked at the balance sheet and income statement and they've said, there's a lot of cash on this balance sheet. And with the spin-off, the other thing that happens with spin-offs is if you spend some time looking at historic track records of spin-offs, most of them are gravely misunderstood at the very beginning. A lot of analysts say to themselves, it's too difficult to figure out the details of the spin-off, thus let's move on and find something that's more easy to analyze.
Sometimes they don't even know who's supposed to be analyzing the company in which division of a brokerage firm.
Exactly. And when you have that confusion, once again, what I'm looking for is inefficiency in information and synthesizing of that information. So when you have a lot of motion, like you do in a spin-off, there's some opportunity there to put a pencil to paper and get a sense of where the valuation is. So that came up on the screen, and then you look to see what Motorola has generally planned out. They're going to split it into two divisions, two separate companies, I mean. And the handset company is going to be debt-free. The $8 billion of cash on the prior balance sheet is going to go to pay down $4 billion of debt, and then the additional $4 billion is going to be cash on the handset balance sheet. So they're coming out of the blocks with a super capitalization, and you need that in a competitive area such as the handset business, because there's a lot of uncertainties in that industry. We saw recently what happened with Apple, for instance, their handset, and so Motorola is going to be competing directly against Apple, and so you need all the shoring up you can manage before you start that attack.
Because you got to keep paying for things like research and development, because the product cycles are getting so much shorter.
Exactly. The product cycles with technology is just increasing at an exponential rate. So as I said, you need all the help you can get, and with a spin-off like that, I would say coming out of the blocks, Motorola looks very, very interesting.
And a clean balance sheet, as you just described, right? It's going to be debt-free, the handset business. All right.
And that's why the bonds have moved up already versus the equity, is because the bond analysts always have that mindset: cash flows, balance sheet, income statement, leverage.
All right. I want to thank you very much, Peter Andersen, coming in from Congress Asset Management, sharing that insight, that connection between what the bond analyst sees and what equities might do.